This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the nightmare has started, and I want you to see how this is going to spark an all-out panic, because we've been warning you that the economic downturn is coming to America. We've talked about how it started in China and how it's moved over into Europe, and that eventually it was coming here. And what do you hear from the policymakers? That this can't happen. We're only going to see a soft landing. Well, now the data shows it's here. Plus, we have a sponsor for today's show. You may remember Eon Biopharma. Well, they're back with a big announcement. And the last time we featured them on our show, the following day, the stock jumped 30% in intraday trading. I'm going to make the case of why this time I think it's going to be a whole lot more. Stay tuned for more information, or check out the pinned comment or description below. Now, if you're wondering what we're doing in Texas today, well, we're not looking for oil. We're looking for economic activity, because the nightmare, it's here. Let's over to Bloomberg, where we picked today's story up with a headline: U.S. consumer confidence falls by more than forecast in August. The Conference Board's index fell to 106.1 this month from 114 in July. Now, this is really important, because when you talk about confidence, when people are feeling more confident about their finances, what do they tend to do? They go out and spend money, they borrow money, and then they spend some more money, and that leads to economic growth. So when you look at these confidence surveys, when they start to decline, well, it tells you that spending is going to follow. And what have we been hearing from retailers and wholesalers? That they're seeing demand drop, they're seeing consumers start to pull back. And what do we hear from policymakers? No, the consumers just kind of backed up a little bit, and they're getting ready to spend. Well, these confidence surveys are telling us now the economy is indeed headed much lower. The group's gauge for current conditions, that's how people feel right now, fell to 144.8, the lowest since November. So going the wrong direction. The measure of expectations, or what outlook people feel about where their things are going for their finances and the economy, which reflects the 6-month outlook in this survey, dropped to 80.2. So this is dangerous as well, because it's not just a matter of, well, I don't feel good about the economy and my finances today, so I'm not going to spend today. But what if I feel really optimistic? Maybe I've been unemployed and I have a job lined up that I'm waiting to get hired. Well, that means my optimism would increase. So the fact that we're seeing the 6-month outlook decline is bad news for the U.S. economy at a time we need it to turn around in a big way. A gauge of expected inflation a year ahead edged up to 5.8%. That this won't last much longer either, because if consumers don't spend, prices aren't going to go up. And while they've been enjoying some relief from abating inflation, still high prices continue to weigh on sentiment. Well, perhaps not exactly the way the author thinks. We'll look at that in a moment. And consumers are once again preoccupied with rising prices in general, and for groceries and gasoline in particular. Now, one of the views that people have here is that consumer confidence and inflation are inversely proportional. So as inflation goes down, we would expect to see consumers become more confident. Well, that's not exactly how it works, because when inflation is going down, what it means is demand is going down, and of course, confidence should be following at some level here. Well, what we do actually see is confidence leads inflation. And while we don't have the Conference Board's data, we do have the University of Michigan consumer sentiment, and we'll note that these two data series are very similar against the consumer price index, that shown in red on a year-over-year rate of change. And what we can note is that even in periods of rising inflation, as confidence comes down, what do you expect that happens? People spend less, and eventually inflation comes down. You see that in the late 70s, early 80s. How about here in the 90s? What happens? Confidence comes plummeting down, and with a lag, and it makes sense. Again, we don't see it in the data and immediately. We see it a little bit later. Once consumers stop spending, inflation comes down. How about going to the dot-com bubble? Same effect. A global financial crisis. We can note that confidence was coming down ahead of inflation. Rising inflation caused consumers to stop spending, as we made the case they haven't had the income to cover it. And then as confidence continued to fall, inflation went into deflation. Now we're starting to see that effect again. What happened is inflation rallied, confidence came down, then there was this hope that perhaps, falling inflation would be a good thing. It's turning out it never actually is as good as it sounds, and we see that rolling over in the conference board data, suggesting that inflation is indeed coming down. And along with that, the yield on the 10-year Treasury securities plunged and stocks extended gains. But one of those has got it wrong. Let's take a look. Because when confidence goes down, what happens for the broad economy is, again, people spend less money. And of course, if they spend less, that means revenues from companies go down. And of course, their costs are up due to inflation. So that means their profits fall. And while everyone believes the stock market should be going higher here, well, consumer sentiment from the Conference Board, and I bet the University of Michigan follows suit here in a future report, tells us the path to their equities is lower, not higher. And here you can see the University of Michigan Consumer Sentiment Survey that's still in blue against the Wilshire 5000 price index. That on a year-on-year rate of change, and you can notice the relationship here is pretty good. As consumer sentiment increased, what happened with the Wilshire 5000 is it actually is kind of leading that, suggesting, hey, as market on a year-over-year rate of change rallies, people feel the wealth effect, they spend more. But what we're finding out, that just isn't enough, because not that many people, you think about the market is about 10% of the 90% of all stocks is owned by 10% of the people. So the wealth effect just isn't having a big impact. But one place it should be is on the rates market. And what we saw today is rates go down, because normally the relationship here, and it makes perfect sense, as we look again at the University of Michigan Consumer Sentiment Survey against 10-year Treasury yields, now not shown on a year-over-year rate of change, just the regular percent, that in red. As confidence goes down, why do rates fall? I want you to be thinking about this. You see this. Confidence goes down and rates go down. There's a very simple explanation here. If you're trying to stoke demand in a debt-based economy and you need people to borrow and spend, are they going to do it at higher rates or lower rates? Well, of course, rates need to come down to spur, of course, increased spending. And let's look at what's going on now, because the market thinks the rates need to go higher. The Fed thinks the rates need to go higher, but the confidence continues to go down, which suggests that the eventual path for rates is not going to just be lower. It's going to be a lot lower to get consumers to turn around and spend. And we noted in a prior show that the biggest risk we face here is a rollover in consumer sentiment. Although economists have been pushing out their recession forecast on renewed economic momentum, many are still anticipating a downturn in the next year as consumers show sign of weakness under the surface. And some Americans are turning to credit cards to make ends meet, while others are cutting back on spending. Again, you think about cutting back on spending doesn't lead to economic growth at all. We note that once the banks put a limit on how much people can borrow on their credit card, which what we can guess is already starting to happen, that means, of course, the debt-based expansion grinds to a halt and starts to turn around. And this has a major impact on the U.S. economy, as we're going to see here in a bit when we take a look at what's going on in Texas. But one thing we're not expecting a downturn on, well, that's the stock for our sponsor, Eon Biopharma. Let's take a look. They just had a major announcement. They had the positive results from their phase 2 clinical trial of ABP 450. Again, there's links to all this in the description and the pinned comment. But the big talk here is the last time we had them on the show, the following day, their stock jumped 30% in intraday trading. Check this out. I'm going to make the case of why I think it's going to be a whole lot more. You can find them on the New York Stock Exchange under symbol AEON. And here we go. This is the last time they were on the show. The night before, here they opened up, gapped up higher, and then in intraday trading, over 30% move. Now, look what's happened now. Some short sellers have come in and driven the stock down. It's starting to bottom out here, and I'm going to show you where the buyers are at. And if it gets back up to around this $7 price range, well, that move is going to be well more than 50%. And that's our base case of where the stock is going, because the RSI, we see momentum momentum building. We see the MACD, this here on the 2-hour chart, is moving into positive territory as we see a nice bottom forming here, momentum starting to shift, and that means this short sellers, these sellers in here, are going to get worked out really, really quick, as of course if buyers step in and move the price higher. And here you can see at $4.33, just above the current price, what we see is where that volume profile is, where all those buyers and sellers at, and that's our case. You see this get up to that $7 price range, and that means a big move for Eon Biopharma, symbol AEON, on the New York Stock Exchange, because one thing else that's changing here is job openings are shifting. Now remember, the market has expected a wage price spiral. We hear it from the Fed. They think there's too many job openings. And now we're going to take a look at our former Fed chair, now U.S. Treasury Secretary Janet Yellen's favorite economic indicator. We've called this. We said it was coming down. Everyone said, no way, you got it wrong. Check this out. U.S. job openings declined by more than forecast to 8.83 million, and what's that time? This should be going higher. The number of available positions decreased to 8.83 million from 9.17 million in June, according to the BLS. The so-called quits rate, which measures voluntary job leavers as a share of total employment, dropped to 2.3%, the lowest since the start of 2021. And as exactly what this means, Americans are less confident in their ability to find another job in the current market. Now, we know in the past, when inflation is going up and wages are going up, one of the easiest ways for employees to get higher wages is not from their current employer, but to job hop. And so what we're seeing now is the data is saying, look, they're getting nervous, they're not confident, they don't want to change jobs because they're not sure if their job's going to last there. And one of the cases we've made is when the economy slows down, what happens? Employers take those help wanted signs and throw them away because they don't need them. And check this out. We've said this was going to happen, and the market said no, the opposite was, because I want you to see, here's the JOLT survey in blue against the Wilshire 5000. Again, this is the total U.S. stock market, that in red. And look at the beautiful relationship here. As job openings are expanding, the market goes up because it tells you the economy is expanding. And when the economy slows and contracts, well, what happens? We don't need those job openings. In fact, we don't need labor as much. And you see this beautiful relationship. And what's happened is investors have been driving the equity market higher, believing we're in the early phases of the next big bull market. And what you're seeing in the JOLT survey is just the opposite. As again, adding to the narrative that the likely path for the market now is lower, not higher, which will catch a lot of investors off sides. And fewer vacancies paired with increased labor force participation have allowed for greater balance in the labor market and helped temper wage growth, in which we've been making that claim, not just wage growth, but total compensation. Of course, they throw us a softball here. We'll look at that in a moment. And despite the easing in demand for workers, unemployment remains historically low, at least for now. So let's take a look at the JOLT survey against total compensation. What we're doing is looking at the total weekly hours worked multiplied by the average hourly earnings for production and non-supervisory employees, putting that on a year-over-year rate change against, of course, the JOLT survey. That JOLT's in blue, total compensation in red. And it would make sense as job openings increase. What would we expect to see on a year-over-year rate of change? We would want to see total compensation rising. And as, of course, those openings roll over, guess what happens? Employers don't need to pay as much, so they don't give out big raises like they did before. And now what we're seeing is total compensation heading lower. Only makes sense. Pull those help wanted signs. They aren't needed. Base case now, equity prices to the downside. But how about Texas? Remember, we're here looking for economic activity as Texas manufacturing activity weakens and employment growth slows. Look at this. Texas factory activity contracted again in August, according to business executives responding to the survey. The production index, a key measure of state manufacturing conditions, fell 6 points to minus 11.2, the lowest since May of 2020. Now, this is staggering. Of course, you have to go, we're going all the way back to the pandemic, and we're seeing all this data reverse, and it makes sense. When you have a massive expansion in credit and money in an economy, you create a huge bubble, and when you pull the reins back, eventually it pops. We're starting to see the early signs of that now. And other measures of manufacturing also indicated a contraction in August. The new orders index has been in negative territory for more than a year and also posted a reading of minus 15.8, although up slightly in July. Capacity utilization, which is a great metric for inflation, edged down to minus 3.7%, and the shipments index dropped 14 points to minus 15.8, suggesting, as we're looking for, there's no economic activity in Texas. And when we take a look at the current general business activity, the diffusion index that's shown in blue against crude oil, the West Texas Intermediate. Now, for those who are looking to hack our CTA-Timer Pro report, look, we're giving you a lot of this great insight because when you understand what the manufacturing sector in Texas has a great relationship with crude oil. So what happens is when everyone gets bullish about where the economy is headed, they speculate on higher crude prices. But what we're seeing in Texas is saying prices shouldn't be going higher. Should be going lower. And here you can see the last time going back to the global financial crisis, we saw a big drawdown in current general business activity, indeed a contraction as it fell below the horizontal black line. Crude oil rallied and came crashing down. Big insight, of course, to where we think the course crude can go. And you notice the relationship here is fairly nice. Again, speculators trying to drive prices higher, thinking the global economy is turning around, and Texas manufacturing sector, saying no, that's not going to happen at all. And of course, what does that ultimately mean? Well, when we see a slowdown in new orders, now we don't have data, chart data for Texas, but we do for Philly Fed. And we know that when new orders go down, that's shown in blue, and we see that contraction. What happens almost side by side with it? We note the 4-week moving average of initial claims heads higher. So this notion that, of course, unemployment, the unemployment rate remains low, that's just not going to last forever. And because perceptions of broader business conditions continue to worsen. So again, signs that it's getting worse in August. The general business activity index stayed negative, but ticked up to minus 17.2, while the company outlook index was largely unchanged at minus 18.4. So what you're seeing here, as it says, uncertainty regarding the outlooks continues to rise, and this is not a good sign because, as we talked about with consumers, they don't spend when the outlook is bad. Well, what about businesses? If your outlook in your business is not good, are you going to spend a bunch of money? Well, probably not. And again, it all starts to kind of create a self-feeding feedback loop here. As labor market measures suggest slower growth in employment, no shocking there, and shorter work weeks in August that will lead to lower total compensation, of course, less spending, and that is coming. Let's take a look at some of the respondents, what they had to say. For the first time in a long time, we're seeing customers reduce or cancel orders due to softening end-use demand. Their customers, of course, they're not referring to you and I, that's the end use. We expect this trend to continue over the next few months. We continue to make capital investments, focus on buying high-quality used equipment at a discount. Customer orders came to a sudden halt. The overall volume dropped 51% year over year. That is staggering. Look at this. Our industry is in a technical recession, if you can imagine that. How about here? We've been very fortunate to have a large job that sustained us for most of the summer. But without this large job, we have been stupid slow like a lot of our competitors. There seems to be a softness in our industry right now. And because of that, we're worried about what 6 months from now looks like. And again, this isn't what you want to see for a whole lot of hiring to happen. So we made the case this was coming to America. We're starting to see it in Texas. It's going to spread as we'll get more data from the other regional feds over the next month. But what's going on in China? Well, now things have gone from bad to worse. There's a lot of panic is setting in. As China banks to cut rates on mortgages, deposits, and stimulus push, no surprise, lose your banks, you lose your economy. As China's largest banks are preparing to cut interest rates, get this, on existing mortgages and deposits. If you can imagine that, have someone cutting your rate on your existing mortgage, talk about a desperate situation. The big state-owned lenders are reducing rates on the majority of the nation's 38.6 trillion yuan of outstanding mortgages that may come as of Tuesday. And of course, these reductions will only affect the mortgages on first homes. But the idea here is, what does that mean? Improve the cash flow to get people to spend. I bet you it doesn't work. And lenders such as Industrial and Commercial Bank of China and China Construction Bank are poised to also cut deposit rates later this week for a third time this year. And these moves are part of a targeted push by Beijing to spur consumer spending, drive more funds to the stock market, and alleviate pressure on lenders' profit margins. And here we can see, of course, mega banks way further deposit rate cuts. It's not just a little bit, it's going to be even more. They're looking to go 5 to 20 basis points, asking people who on the inside did not want to be identified. Because why? Because the whole idea here is the Chinese economy is in bad shape. They're trying to get people some more money in their pocket, trying to get out of the banking system. And if this sounds familiar, we've done it too. Check this out. Deposit rates could also encourage households to shift away from bank deposits toward other investments and consumption, or at least that's the hope if they don't want to save it. But Chinese households increased the share of their income that they saved during the pandemic and shifted their financial assets toward bank deposits, hitting the performance of funds that buy stocks and bonds on behalf of households. Why? Because they have no confidence in the global economy. They're seeing the slowdown, and that's why, my friends, I'm saying the nightmare, it started, it's here now, it's hit American shores, and this is not a good thing. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.